Hello, good afternoon, and welcome to today's episode of Modesty's Mortgage Masterclass. Okay, we're here again, and it's me again, your man, Ikenna Umezudike, the director of Modesty Financial Consultants Limited, a financial services company based in Luton, United Kingdom. And we are specialists in mortgages of all types, financial advice and financial consulting, and investment advisory as well. As we always do every Wednesday, we gather here, we learn about mortgages, about the latest in the property market as far as the UK property market is concerned. We educate and enlighten ourselves, getting ourselves equipped to confront the market's challenges out there in the property sector, especially as it pertains to mortgages, because we believe that information is power, and by empowering you, our viewers, with the latest and the most recent information that you require, you'll be better equipped and in a better position to take on those challenges when it comes as per how to deal with property issues and especially your mortgages. So whether you're a first-time buyer or whether you already own a property and you already have mortgage or mortgages, we still think you find these sessions very, very useful because it keeps you up to date, because the market is continuously changing and you need to keep up to date with what is happening in the market. You cannot have a mortgage and not keep yourself up to date with the mortgage market, and that is what we always endeavor to do here every Wednesday. So this is our Modesty's Mortgage Masterclass session number 24, right? And today is my son's birthday, the last baby in the house. He turned 4 today, and I wish him a very happy birthday to my dear lovely son Williams Ifechuku Umezudike. He is such an energetic boy, and everybody says, hey, he looks very much like Dad, and I don't disagree at all, because I look at him, so all the things he does reminds me of my younger self. So just spare a little moment in your time and just pray for him and wish him well when you can. So yeah, we're gonna come back to the birthday cake later, but today now we mean business. So let's get down to business. So today, what are we going to be talking about today? We're going to be talking about the first home scheme, which the government has introduced and have released a white paper on. You will be very, very interested in hearing this. And we're going to be talking about our romance with the very low rate of mortgages. Is the romance over already very soon? I don't know, but stay tuned, you'll get to hear about that as well. And then we're going to be talking about some live cases that we've been handling and be treating here at Modesty Financial Consultants, just to give you an idea of what we are doing and how we deal with things. Okay, so first of all, let's talk about the mortgage rates. Is the low mortgage rates honeymoon over already? Remember, about a couple of months ago, everyone was screaming, wow, mortgage rates have never been this low. The Bank of England lowered the base rate to 0.1%, and everybody was screaming. I was like, we have never had it this low. It became the lowest ever base rate in the history of, whenever records began, since records began. And then mortgage rates were plummeting. Lenders were reducing their rates, and people were like saying, can it go even lower than this? We don't know, but it kept going down and down and down. But now recently, we have noticed that there has been a change in the direction of mortgage rates. And that change in the direction, it means that mortgage rates are now going up again rather than going down. And then everybody's like asking, is the honeymoon over already? Why are mortgage rates going up? Base rate hasn't gone up, so why are mortgage rates going up? More and more lenders are putting up their rates. More and more lenders are increasing mortgage rates, the rate at which they lend. And, this goes against expectations, it goes against the trend, it goes against circumstances, and people are just asking questions. But we're going to bring you answers to those questions right here, right now. So, according to MoneyFacts, the data from MoneyFacts shows that there has been average, the average mortgage rates across all tiers of mortgages have gone up recently. In fact, it shows that the average mortgage rate for 2-year and 5-year fixed rates have gone up by 0.09% overall, right, across all tiers. Now, it means that 2-year average fixed rate for 2-year mortgage fixed rates stands at about 2.08% on average, and for 5-year fixed it stands about 2.34% now on average, right? But the biggest increase in the mortgage rates are happening in the high loan to value range of mortgages. So, for example, in the 85% loan to value mortgages, that's where the biggest increase in rates are happening now. The average rate in 85% loan to value mortgages has increased by 0.21%. That's for 2-year fixed. And the average rate for 85% loan to value 5-year fixed mortgages have increased by as much as 0.23%. So on average, you are looking at, for 2-year fixed rate on average, for 85% loan to value on average, you're looking at 2.32%. And for 5-year fixed rate on average now, you're looking at 2.57%. And all these within the last 1 month. Okay? And then not only are we experiencing increase in the mortgage rates, product choice is also reducing. And you've been asking, can it get any worse? So average mortgage rates are increasing, and then product choice and availability are decreasing. So as at the start of August, right, mortgage products in the market have shrunk by as much as 202 products. So about 202 products have been withdrawn from the available mortgage products in the market as at the start of August. So that's within July alone. And now compare that to what it was as at the beginning of March. As at the beginning of March, there were over 5,100 mortgage products as at the beginning of March. And now we have just about 2,526 mortgage products in the market as at the beginning of August. Look at that difference. So there are over 2,600 products fewer as at the beginning of March and at the beginning of August. So between the beginning of March and the beginning of August, the mortgage market has lost over 2,600 products. So that will tell you that how lean the products that are available in the market now are. That's astonishing. That's an astonishing amount of products to withdraw from the market. Okay, so all these numbers that we're talking about, what are they telling us? Now, what it means is that mortgage demand, there is serious, demand for mortgages. Mortgage demand has skyrocketed, especially since the easing of lockdown, in May around the property sector. Mortgage demand has skyrocketed. It has increased astronomically. All right, and this has been fueled by the easing of the lockdown. It has been fueled by the stamp duty holiday, which was introduced by the Chancellor on the 8th of July, and then by the record low mortgage rates that came into play after the Bank of England lowered it. So all these factors contributed to mortgage demand increasing in alarming numbers. So people wanted to buy properties, people wanted to take on mortgages. There was serious demand for mortgages. Okay, now with these increases, it brought about massive pressure on the lenders and the banks, and then their operational capacity became very stretched, and it's also has been affected by the pandemic. Remember, I said it before on in one of my sessions. A lot of bank staff who are dealing with mortgage applications, a lot of them work from home these days. So they have very few people in the office to answer phone calls, to take inquiries, and to do it. So their operational capacity has been challenged they haven't got the manpower and the capacity to deal with the skyrocketed demand in mortgages, right? So it has put massive pressure on the lenders and the operational capacity as a result of this increased demand in mortgages, right? And this increased demand has been fueled by the things I mentioned, the lockdown being lifted and people wanted to move on with their lives, and there were lots of mortgage deals that were outstanding before we went into lockdown. So the moment the lockdown got lifted, people wanted to complete those property deals and they wanted to carry on, completing those mortgage deals. And then came the stamp duty holiday, and hey, hooray, we're not going to pay stamp duty for properties worth up to £500,000. So everybody wanted to do deals. And then people now saw that mortgage rates are at their record low. Wow, this is the best time to go buy a property because mortgage rates are at their record low. People wanted to buy properties. So all these inquiries were pouring in to the banks and lenders, and they became overwhelmed. So now, because they became overwhelmed, the banks had to react somehow. But then something also happened. The banks, even though there is demand for lending, for mortgage products, there is something that's concerning to the banks. The economy. The banks and the lenders, they worry about the economy, and because there is lack of clarity around the economic situation, because there is so much uncertainty around the UK economy, especially with employment and jobs. The government's furlough scheme will come to an end at the end of October. And after that, what happens? Nobody knows what's going to happen. And the banks don't know either whether the employers are going to reabsorb those people who have been furloughed, or whether those who have been furloughed are just going to be laid off and become unemployed. Hi, Hugo, good afternoon. Thanks for coming on. Yeah. So nobody knows what's going to happen. The banks don't know. And there is a serious link between employment and mortgages. Because if people don't have jobs, how can they afford the mortgages? If people don't earn, how can they afford the mortgages? So it's a big risk for the banks to take, to lend to someone or to people who haven't got means to service those mortgages. It will be irresponsible on their part. In fact, just yesterday, it was reported that there has been over 750,000 job losses already in the UK. Debenhams cut about 2,500 jobs just yesterday. So information and news like this scares the banks. And they have to, because of that worry and that uncertainty, they have to react somehow. Okay? And, around the furlough scheme, nobody knows what's going to happen. So the economy and employment is a big worry to the banks because it all links into affordability. Now, so again, these lenders have to set some money aside, for further COVID-19 preparations, to be able to cope with the challenges of working in these challenging times. For further coronavirus plan, they have to set some money aside as well. Besides, the banks, the profits of the banks have been falling. The bank's profits have been falling because of COVID. It has also affected their level of profitability because they cannot do business at the capacity they used to do before COVID-19. So there's a lot of adjustments to do, right? So the uncertainty, the falling profits, setting money aside for more coronavirus planning and all that, these are pressures that the banks are having to deal with. So all these factors put together led to the lenders deciding to either, because they cannot also cope with the level of inquiries that are pouring in, because their operational capacity has been limited by COVID-19 as well. The lenders have to react in a way to say, okay, how do we discourage more inquiries from coming in? So it's either we make less products available or we increase the rates. And unfortunately, they have decided to do both. So they are making less products available and they are increasing the rates of mortgages. So that's why you have seen mortgage rates go up recently, because the banks are trying to discourage people. That's really funny, isn't it? They're trying to discourage people from inquiring and from taking on mortgages because they have more than enough already on their plate to deal with. The appetite to lend is not that strong unless the case is watertight. Okay, so they are saying, okay, if we must take this risk, it has to be worth it. So we have to pick the best bunch of our products that are very less risky, put it out there in the market, and therefore we're looking for the less risky clients. And then if they can afford to pay the rates that we have put up, then we can lend. So the banks are withdrawing more products and putting up rates to discourage mortgage inquiries. And that's what exactly has been happening in the mortgage market. So as long as these issues, linger on, it will be difficult for us to return to the era of historic low mortgages. It will be difficult. Because as long as these issues that I've mentioned are still there to be dealt with, both by lenders and and borrowers, those historic low mortgage rates that we enjoyed and that we were talking about a few months ago, it will be really difficult to get back to them because the uncertainties are still not clear. At least for a few months, it won't be clear until at least the furloughed scheme has some clarity around. At the moment, nobody knows what's going to happen to furloughed workers by the end of October. So at least until the end of October, we are not sure we're going to return to that era of historic low mortgages again. But then, hey, this is an ever-changing market. You never say never. We don't know what's going to come up tomorrow, and the market might change. But at the moment, this is the way we see it. So the choice of mortgage products and the availability of those mortgage products remain the biggest challenge for borrowers and remain the biggest issue for borrowers and for those in the mortgage business, because the lenders are becoming very cautious and their appetite to lend is becoming leaner because of these uncertainties and the risks. So they have to be sure that everything is risk-proof. Besides, the lenders are also having to set some money aside because they are anticipating a high level of mortgage defaults because of COVID-19. A lot of people are struggling financially, and a lot of people will struggle financially to keep up and to meet up with the payment of their mortgages. So the lenders are not only setting money aside for extra coronavirus planning, they are setting money aside in anticipation for more mortgage default. So it's a strange time that we live in at the moment, and things are just happening upside down. A time when people are expecting house prices to be falling because officially the UK is in recession. Okay, officially, and the biggest and heaviest recession the UK has ever experienced. So at a time like this, it's all, every indication should be house prices should be crashing, should be falling. But on the contrary, house prices are going up. Everybody is expecting mortgage rates to be crashing because people are not keen to get mortgages. On the contrary, mortgage rates are going up. Everybody's expecting mortgage demands to drop drastically because there is no money. On the contrary, mortgage demands are skyrocketing. It's really a strange time we are living in. And strange things are happening because everything seems to be happening the other way around. So people are expecting a crash in the property markets. The property markets has never been stronger. Demand has been strong. Rental demand has been strong. Sales demand has been strong. Mortgage demand has been strong. Mortgage rates are going up instead of coming down. I mean, what else is left to see in this market? But we're here and we're going to bring you up-to-date information as it all happens. So in this strange time that we're living in and things are happening in opposite direction, it's a time for us to, just my advice would be, or my little tip would be, listen, because choice and availability of mortgage products are limited at this time and rates are going up, lenders' appetites are not yet fully wet. So if you have got a good mortgage deal at the moment, take it and run with it, okay? Because you don't know what's coming or what's around the corner. Take it and run with it. If you've got a good mortgage deal at the moment, take it and run with it, because if you had products are being pulled out of the market almost on daily basis. The product you have today, you might come tomorrow to make a full application on that, and the lender will say, hey, that product is no longer available. You've got to pick from another product that we have. What can you do? So if you've got a good mortgage product now, grab it and run with it, because you don't know how long it's going to be on the market for. Okay? You might be delaying, and you might be cheating yourself out of that very good deal. All right, so that's part with mortgage rates and whether our honeymoon is already over so soon. The next thing we want to talk about is a scheme that the government has introduced, or will be introducing, although they have released a white paper on it, right? It is called the First Homes Scheme. Wow. Some of you might have heard about that, while some haven't. But that's my job. That's why I'm here. That's why I come here every Wednesday, to tell you things, even though you know them, but there might be some more details available. Or if you don't know them, then you've heard them here first. And we are here to bring you that information and to educate you. Now, the First Home Scheme, what is it all about? So the government has released a white paper on a scheme that they call the First Home Scheme, and how it works. Although the details are still scanty at this moment, but at least we've got a few information around that that we'd like to share with you today. So the First Home Scheme is another scheme set up by the government to help first-time buyers, and this time around not just first-time buyers but key workers, to get on the property ladder. Key workers have never been more important than now. The COVID-19 have really taught everybody in the UK and around the world to appreciate key workers, like the police, like teachers, like nurses, like carers, even warehouse workers, truck drivers, and all, people that kept us going even while we were in lockdown. You know, doctors, medical health professionals. These are ambulance drivers, and these are people that kept us going while everyone was on lockdown. They were still. So that's why they are called key workers. So this scheme is meant to help first-time buyers and key workers get on the property ladder. So first homes as they are called, they are flats and houses just like any other house or flat that are built on developments. So it has to be like a new build at the time, yeah, built on developments in the UK. It's not different from any other property, like other normal properties, but this time they will be sold at, wait for it, they will be sold at 30% discount. Okay, so first-time buyers and key workers will be able to buy a property in their local area from a developer at 30% below market value. How about that? Now, so first-time buyers and serving members of the armed forces and key workers such as police and teachers and nurses, these people will be prioritized in this scheme that the government is introducing. Yeah. So, and when these homes that qualify for first homes are resold, that discount will pass on to the next buyer who falls in the same category. I'm going to come to that later on. But so how does this work? Yeah, this is how it works. So first homes, as they will be called, will be sold with a minimum discount. So that means discount could even be more than 30%. But the minimum discount you're going to get from the homes that qualify to be first homes is a minimum of 30% discounts. Yeah? Although local authorities could actually apply a bigger discount if they want, to ensure that these homes are available to their local people. Now, there will be a pilot scheme. You know, let me just put that into perspective, right? Say if the market price of a property is, say, £200,000, if that property qualifies for the first home scheme, the buyer, say you're a first-time buyer or a key worker, you want to buy that property will be sold at 30% discount. So that £200,000 will be discounted by 30%. So you're buying that property £60,000 cheaper So instead of paying £200,000, you will be paying £140,000 for a property of £200,000. How about that? 30%, that's 1/3 of the cost of that property discounted. Okay, so there will be a pilot scheme, first of all, of 1,500 homes that will be earmarked for the first homes. This pilot scheme will run. And when this scheme kicks off, the first 3 months, in the first 3 months of this scheme, it will be purely reserved for first-time buyers and the key workers. Now, after that, and this will be for people who live in the local area. Okay, so the local authorities will be able to set the criteria for how they define people who live in the local area. So the idea is for government to encourage people who live and work in the local area, but they could not afford to buy properties at the market price in that local area, but they still want to live in their local area, to be able to access properties at a 30% discount, right? So these are people who live in that local area and who qualify either as first-time buyers or as key workers. So in the first 3 months, yeah, this scheme will reserve that property for people in this category only. And then after that 3 months, homeowners will be able to buy those first homes and wherever they want to buy. People will be able to buy, those first homes wherever they want to buy in the UK, whether they are in the local area or not. Homeowners will be able to buy that after the first 3 months. Okay, so if there are no takers for that after the first 3 months, homeowners will be able to buy that wherever they are. Hi, Chini, good afternoon. Thanks for coming on. So, so when this scheme is launched, yeah, 25% of what the government calls affordable homes on any development will have to be first homes. So as a developer, when you want to develop an area, when you want to build houses in an area as a property developer, there is a mandatory proportion of that property you are looking to build, if you're a developer in the UK, that the government will ask you to designate that as affordable homes. So the government is now saying, if out of the affordable homes, the homes that prefer to be affordable homes, that 25% of them will be now earmarked for this first homes scheme. So to qualify for this first home scheme, the household income must not be more than £80,000 if you live outside London. If you live inside London, the household income must not be more than £90,000. This is just to make sure that this scheme is for those who the government consider either key workers or first-time buyers who have real need for this discount, and not just, hi Onyinye, good afternoon, thanks for coming on, and not just anyone who's earning like £200,000 and you want to take a property at 30% discount. No, the government wants to make sure that this scheme is beneficial to those that they target and the people who actually need it. Now, so the first home scheme, the house price will be capped at £250,000 in England, and then inside London the price cap will be £420,000. So for most part of it, first-time buyers will qualify for the scheme, but among the first-time buyers, key workers as well will also be prioritized. Now there will be exceptions. There will be exceptions for people who are not first-time buyers or key workers, but these exceptions have not been clarified. So as more details emerge, the government will clarify and give more details as per who these exceptions refer to. But there have been provisions made for exceptions for people who are not either first-time buyers or key workers to be able to benefit from this. But the government will come up with that, with details on that exceptions later. So the process of buying these first homes will not be any different from buying a normal property, and you'll be able to access mortgage as well, conventional mortgage as well, just like you're buying any other property, but just that it's at a discounted price, and that discount is paid for by the government. So the when the owner of the first home now decides to move on, for example, you want to upgrade, you want to buy a bigger property, then you need to sell that property that you bought at 30% discount. What will happen is that property will be independently valued. and then the valuation of that property, whoever is coming to buy that property will get 30% discount on the current valuation of that property. So this discount will now be transferred to the next buyer. And the government intends to keep it going for generations. No matter the generation that is buying that property, that 30% discount will continue to run for that generation. So if, for example, you bought that property at 200, that property was worth £200,000 when you bought it, right? And you bought it at a discount of 30%, which is £140,000. If after 5 years or so, the property is now revalued and it's now worth £250,000, whoever is coming to buy that property must have to fall within the category of people who should benefit from first homes. So that person must be either a first time buyer or whatever the criteria is at the time the person is going to buy it. Will now get 30% discount of that £250,000, which is the current valuation of that property at the time the person is going to buy it. So the person will now buy that property at £175,000 instead of £250,000. Okay? And so it goes. So it will be transferred from generation to generation. So once a house or a property is earmarked as first homes, it will remain first homes, and the 30% discount will be applied across generations. Okay? Now, it means it will continuously be discounted. That's what it means. So local authorities will continue to allocate these homes to buyers that they feel fall within that category, and they will continue to prioritize key workers as well. Now, first homes, this is very important. First homes are only meant to be residential properties. So they cannot be bought as holiday homes, and they cannot be bought as buy-to-lets. For those property landlords now that are licking their fingers and thinking, I sense an opportunity here. No. This is for residential purposes only. So they cannot be bought as a buy-to-let, and they cannot be bought as second homes. Okay, so when will this scheme be available? Details of that will be available later, because the government are still consulting on how on when that scheme will be available, and to add more details to it. But these are the details that we obtained from the white paper that the government has released on this. Okay, and once we hear more about this, we'll bring it here again for you for your own consumption. Now, time for us to talk about the live cases that we are dealing with, just to give you an indication, an idea of what we do and the sort of live cases that we handle here. Now, a client was referred to me by an accountant who refers clients to me all the time. And one unique thing about this accountant is that he always, I don't know whether he does it deliberately or it's just out of the confidence he has in what we do. If any client is having, if there's any complex mortgage issue that comes to his notice or to his accounting practice, you know what he always tells those clients? If there is anyone who can solve this mortgage puzzle for you, he has to be Kenna. So I will give you his number, talk to him, and I'm sure he will sort you out. So I've had 3 clients come to me from this accountant who have told me the same thing. And they said, hey, Ikenna, this guy said if there is anyone who can solve my complex mortgage issue, it has to be you. And that's why I'm reaching you. And I'm thinking, I'm saying to them, why is this guy always putting me under pressure? I am not a magician. Yeah, I'm good at what I do anyway. I'm not going to deny that. But then, when the extra pressure comes with that, you've got to live up to it. So I'm grateful for that. I'm thankful that he finds me worthy of such a high recommendation. But so what this case is one of those cases that he sent the client to me. So what happened here is this client inherited a property. That property is worth over £1 million. Okay, and of course in the UK there's something we call inheritance tax. In some quarters it's called death tax. So when your parents or your loved ones die and they leave a property for you to inherit, if the value of that property plus other assets that you inherited from them goes above the threshold of £325,000, yeah, anything on top of that is taxed, and the tax is usually heavy. So this client inherited this property, and the inheritance tax bill was as heavy as the value of the property, and he couldn't afford to pay it, and he didn't want to sell the property to pay it. So what he did was he took a bridging finance and secured it against the property so that he could pay the inheritance tax bill. And of course, you know, bridging finance is a short-term property financing option, and he bridged that property for a year. Now, as the client told me, the bridging finance pulled a fast one on him. They agreed to lend him a certain amount, which includes the cost of refurbishment on that property. They agreed to lend him that amount. And then when they came to value the property, they now said, look, this property is not in a habitable situation. We are not going to lend you as much as we told you we are going to lend you. So you are going to cough up the money for this refurbishment. We're only going to lend you this much, but the cost of refurbishment now has to come from you, and you have to put this property in a mortgageable, in a livable position before we, we can do that, or before we can even lend you more. So he left this guy stranded, and then they loaned him far less than what they were supposed to lend him. He now went about looking for money to refurbish this property and put it in at least a good livable and rentable position and mortgageable situation, which wasn't what he planned. The initial plan was, lend me this money plus some money on top of it for refurbishment so that I can put the property in a mortgageable situation and condition, and then I can remortgage it and then pay the bridging finance back. But then they went back on their promise and they did not deliver on their promise. But then now, 1 year is fast approaching, and now every single day the interest rate increases on that loan, on that property. This guy is having sleepless nights because he cannot afford to lose a property worth over £1 million to the lenders. And every single day they are adding money on top of the interest, because as far as they are concerned, it's gone past the deadline by which he should have started the process of remortgaging, right? And because it's gone past that deadline, there's an extra charge every single day on top of it, and it's killing him. So he's come to me and he said to me, please help. All right, I need your help like yesterday. I really felt for him. I really had serious sympathy on him. So the issue around him is that his income is complex. He has a complex income. So when he came to me and he narrated his story, he told me about what he was. Hi Richie, good afternoon. Thanks for coming on, brother. So I said to him, okay, I've heard all your stories, and then we're going to start from somewhere. So I gathered some information from him, and I said, first of all, we will start by simplifying your complex income, yeah, and package that income in a way it will be easier for the lenders to understand. Because if the lenders don't understand how you earn, it will be difficult for them to lend you anything. So we started going through his income and that of his wife to at least ascertain what that income can carry and how much that income can borrow, and how we are going to present that income to the lenders in a way that will be easy for them to understand what this guy earns and what his potential earnings are like. And then we can now look for a lender that will lend on the basis of that understanding. Okay? So the first solution is to simplify the complex nature of the income. And after going through that session with him and discussing all the options available to him, trust me, the guy, he couldn't hide his appreciation for the way I simplified and I broke it down to him. And he said to me, Kenna, I now understand clearly what I need to do and what we need to do. And no, he's been to a couple of lenders and to a couple of mortgage brokers. He said, no mortgage broker has simplified this and broken it down to me the way you have done. It simply means you understand my situation and you already know where we're going to start from. So we've already started gathering documents and information to make that complex situation more simple, and then we'll be approaching lenders on that simplified form, because lenders hate complexity. If there is one thing that lenders don't like, it's things that are not clear, things they don't understand. So our job as brokers is to get those complex things, break them down, simplify them, and present them to the lenders as simple as ABC, and that's, matters resolved. So what I need you to pick from this case as well is, if you are looking to take a bridging finance on a property, or your property, security against your property, please note that bridging finance is a short-term property funding solution. It's not a long-term solution. So before you bridge on that property, make sure you have a clear-cut exit strategy. And that exit strategy, you have plans on how to activate it as soon as possible. Once you secure that bridging, start working on your exit strategy immediately, right? Don't leave it to the last minute. Don't wait until it's getting close to the time when it will run out, because then you find yourself in a very tight situation, and anything that doesn't add up then means that you cannot exit. And if you want to rule out sale of, outright sale of the property, the other option will be refinance. So if your exit strategy is to refinance, make sure you're already working on the criteria. Hi, Godswill, good afternoon. Make sure you're already working on the criteria that will enable you to refinance as soon as possible. If your exit strategy is to sell the property, make sure you put that property on the market early enough so that you can complete on it. In fact, you can put it on the market 6 months before that bridging finance is due to end, so that you can give yourself enough time to advertise it, to sell it, to negotiate the price, to complete on the sale and all that. Otherwise, you find yourself in a very tight position, right? I will be here to help you, but it will cost you. It will cost you money if you find yourself in that tight position. That's why we're here, to help people who have found themselves in that. So whatever the complex situation is as far as your mortgage needs are concerned, hey, come, let's talk about it, right? The first step is to talk about it, and then we can find a solution, okay? If we don't talk about it, we cannot devise a solution. When we talk about it, we can then know whether we can help you or not. I'm not the alpha and omega in mortgages, but I know what I'm doing, okay? But I will try my possible. That's just what I do. I will do everything I possibly can to help. And until I've explored every option available, I don't give up on any case. That's the way I run my business. All right, folks, thank you very much for being part of this again, you wonderful people. I very much appreciate you, and I very much appreciate you taking out time to listen to all I say every Monday and every Wednesday. And I look forward to seeing you again on Monday when we come for our Modesty's Money Masterclass. And next week, Wednesday, I'll be bringing you some more education around mortgages and properties. Until then, stay safe, stay blessed, and goodbye. Take care. Bye now.